Hello and welcome from Trend Signal for our review of the data and events the week beginning the 15th of December. This is the last full week actually this year. We have Christmas break next week and then the break between Christmas and the New Year the following week. This week starts with equities having suffered a considerable loss the previous week, last week. The FTSE was one of the biggest losers. That fell over 440 points, or in percentage terms, that's 6.5% fall on the week, which is considerable. Obviously explainable by the heavy resource sector, oil and gas sector on the FTSE 100. Nevertheless, it was a considerable move. The US market's not quite as bad, although Friday witnessed a considerable move on both the Dow and the S&P. The S&P 500 finishing the week last week down 73 points, 3.5%. The Dow Jones pretty much tracked that, a lot more narrow index, of course, but that was down 678 points or 3.8%. Other markets also weak. Nikkei, that was down 550 points or 3%, really reflecting this slightly steadier Japanese yen on the forex markets, which has dampened enthusiasm a little bit in the short term. Other than that, the big move last week, as I'm sure you will all see on the news wires, or have seen on the news wires, was oil. Brent crude down $7.21 last week. That is 10.5%, a substantial fall, which really hit the resource sector, the oil sector. They all plummeted sharply. The energy sector, in fact, is down 16.5% on the year in the US, while the main market is actually up 8.4% on the year. So you can see how badly that those sectors have been hit. Beneficiaries haven't been sort of mentioned too much, but obviously the transportation sector, airlines obviously will do well, road haulage. And of course the US consumer, the University of Michigan Consumer Sentiment number last Friday came in at 93.8, which actually smashed consensus of 89.6 and was way better than the previous month's reading of 88.8. But really, despite all the positive news, equity markets stumbled badly. The S&P 500, strangely enough, had its worst weekly decline for 3 years, which is odd considering the mid-October sell-off, but in October, the worst week was the one ending the 6th of October, which was marginally less than last week's move. So there we go. Overnight news, we have had the lower house elections in Japan. Shinzo Abe's Liberal Democratic Party has secured another election victory, which was quite straightforward in a way. I'd say they've cruised to victory, as it were. Obviously, Shinzo Abe has now got a new mandate, although it was rather dented a little bit. Obviously, firstly by the depressing markets on Friday. Certainly that depressed the Nikkei. But also there was a record low turnout, which is a bit difficult to argue a very strong mandate reason for whatever he's going to get up to. But nevertheless, that should be seen in the medium term as quite positive for the Japanese markets. Oil markets, well, what now for them? We've had some news on Monday morning where the Libyan troubles have now forced 2 terminals to be shut, or in the process of being shut, which will remove quite a bit of oil from the world market, 350,000 barrels per day. That sort of has given the market a little bit of a lift. OPEC has reaffirmed production, but I think really the issue is all about supply, or oversupply to be exact. And I think demand, I can't see demand changing. That's sort of quite depressed anyway. Certainly that's not increasing, which is what the oil market would like to see. But there are a number of reasons why oil could rally. The Financial Times has referred to the stripper wells, which are the wells in the US that tapped unloved wells at the end of their economic life, as it were. And these stripper wells yield less than 2 barrels per day, which is almost nonsense, really. But there are 400,000 of such wells in the US, so they actually supply about 11% of oil production. They require a lot of power to extract the oil, and at $60 a barrel, they won't be economic, or a lot of them won't be. So this is an example, perhaps, of how supply could be curtailed as the price falls. And I suppose these are longer term effects, really, but won't affect the short term capitulation selling that we're witnessing, certainly witnessed last week with that dramatic sell-off of $7.50 on Brent crude. So let's have a look at the news and events happening this week. As I said, we've already had seen the Japanese election news. There's a lot out really this week, but let's focus on the core events. Tomorrow in the UK, we have our inflation data. I think it's highly unlikely now, with the move that we've seen in oil, transportation costs really under pressure. I don't think there'll be any threat of any inflationary threat. Certainly it's more deflation, certainly in the Eurozone, but that'll be closely watched. We have a couple of surveys coming out of Germany, the Eurozone's strongest economy. First of all, we have the economic sentiment indicator from investors and analysts. An improving number, 11.5 the previous month. We're expecting 19.8, so an improving picture in Germany. I'll jump to the other index or survey, which is the one coming out on Thursday, which is that really broad-based German Ifo business climate, which is very well respected. It's got a very large base. And again, an improvement there. Nothing too spectacular, though, and I think the Eurozone still has a lot of these problems to tackle. Last week, we had the targeted long-term refinancing operations, which really didn't go particularly well, and I still think that the market is debating as to whether the ECB will be in a position to adopt full-blown quantitative easing in January. There's more talk in the Financial Times about a lot of members of the council who are against quantitative easing, especially from Germany, where they feel it's deflecting from the real job in hand. But nevertheless, that's a task that Mario Draghi will have to tackle in the new year, to try and convince his council members to invoke QE. A lot more to be discussed on that in the weeks to come. Other news this week, or other events this week, we've got UK employment data out on Wednesday, or claimant count as it's called. That'll affect sterling markets. We have CPI data, inflation data out in the US. Again, it's nothing much to talk about, but the core event, or key event I should say, is the Federal Open Market Committee meeting this week, with the announcement made at 7 o'clock on Wednesday evening. It's all to do with the phrase that they've been using, the phrase considerable time in referring to rates staying at the levels that they are at the moment. I think the fact of the matter is the market, that the Federal Reserve will continue to manage the market as carefully as possible, and whilst they're saying considerable time, whether they're using those words or not, if circumstances change, they will change their tune very, very quickly. Other data and news out this week, we have retail sales on Thursday in the UK, and then some important manufacturing data, Philly Fed Manufacturing Index on Thursday afternoon, along with the unemployment data as well. Again, bits of data that can affect the markets. But that's it for the last full week of the year. Thank you very much for listening, and catch you in the new year. Thanks so much. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.